The Microsoft Build conference that is kicking off today.
Indeed it is, and the company is expected to focus almost entirely on how it's incorporating, you guessed it, artificial intelligence into its computers and software.
And at a preview event yesterday, Microsoft gave a sneak peek of what's to come, including the first computer chips that allow users to run AI features without being connected to the internet. So joining us now to talk more about the state of technology and artificial intelligence is Dan Niles, founder and portfolio manager of Niles Investment Management. Dan, we appreciate you taking the time here. And what is riding on this event for Microsoft?
Well, I think it's been pretty well previewed. Microsoft is really trying to get the PC market into the next upgrade cycle, because if you look at last year, obviously PC units shrank. They've been sort of moribund since you had that big upgrade cycle during the pandemic. And so the hope is you put AI features on your PC that can run locally. In other words, you don't have to send it out to the cloud and then wait for it to come back. And that hopefully will help drive an upgrade cycle. And they've talked about these PCs starting at about 1,000, start selling in the middle of June, and they hope to sell 50 million or so over the course of the next year. So we'll have to wait and see what happens, but there's clearly some portion of the population that's ripe for upgrade.
That's the hope. Do you believe it will lead to a surge in PC sales?
Well, that's a complicated question because I also believe the economy is slowing down and that consumers now don't get free checks every week coming into their checking accounts. And with inflation still high, they're going to have to make some judgments on what to spend it on. So if you get a AI-enabled smartphone from whoever your provider is, whether it's Apple or Samsung, will you more likely to spend it on that? Or are you more likely to spend it on a PC? Because I don't think the consumer is going to go ahead and upgrade everything. So I think you got to pick. My judgment is that they're going to be more likely to want to look at smartphones because let's face it, you're not carrying a computer in your pocket, you're carrying your iPhone. So that's the thing that I'm trying to balance out, because right now, you say AI 100 times and your stock goes up and your multiple goes higher, but not everything is going to work. And we're going to get to the point at the end of this year, we're going to figure out what is the consumer willing to spend it on, because I don't think he has the money to spend it on everything. And we've heard that from some of the retailers on how the mid to low end consumer is getting squeezed.
Dan, Microsoft's stock right near a record high, up 1.2% today. Where does Microsoft fall in this AI race compared to other companies?
I think they're in a great spot because unlike the move to cloud computing, which if you remember, Microsoft was behind. Amazon Web Services, they had the dominant pole position and Microsoft had to fight from behind. With regards to AI, they are 50% of the profits of ChatGPT, OpenAI, and so they were in a dominant position from day one. And so that puts them in a very different spot looking forward. They're also very enterprise focused, where Google's more consumer focused. So their presence in AI is what businesses want because of that enterprise focus. So I think they're very well positioned going forward. The biggest risk is obviously the multiple is in the mid 30s. It's obviously high relative to the S&P at 22 times, but I think you have to give them some credit for their pole position.
Of course, with anything AI related, it's all eyeballs on Nvidia reporting earnings tomorrow. What are your expectations? And with so much growth already factored in, what could move the stock?
Well, it's a great question. The biggest risk is that everybody on the planet knows it's a massive beat and raise. But you could have said that about last quarter as well, and the stock was up 16% the next day. The one positive is the fact that if you look at its multiple, it's actually 15% below the PE over the last 5 years on average, the forward PE. So it's actually very cheap. And if you think, well, estimates are going to go up another 10 to 20% on the other side of this print, it's going to get even cheaper unless the stock moves higher. So if I'm going to guess right now, I think the stock does move up slightly on the other side of this, but only slightly because you have such high expectations coming in. And there's also some concern about you end up with a stall in demand in front of the launch of their Blackwell chip, which is their 2.5 times more powerful for only 20 to 30% more, that's launching later this year. So that's the balancing act that's going to be going on.
It's interesting, Dan. We've started to see some fragmentation among the Magnificent Seven, which by and large, since that October 2022 low, have lifted the stock market thus far. We've seen Tesla fall behind. We're starting to see, as I referenced earlier, more bifurcation. So which companies within the Mag 7 do you think are best positioned to continue growing as artificial intelligence evolves?
Yeah, so there's the short term and then there's the long term. Short term, obviously, everybody gets really excited anytime Apple introduces anything and they're talking about putting AI into their smartphones. That event, Worldwide Developers Conference, happens on June 10th. So I think in the near term, through up until June 10th, that stock will remain strong. But if you're talking longer term, which is what probably your viewers care about more, I think longer term, there's four names that I think are really well positioned. Nvidia, obviously, because they're providing the chips that make AI possible. Meta is using AI to really help with generating revenues by monetizing the ads and also the things that they show you that they think you might be interested in watching. Amazon is the biggest cloud vendor out there. And so for companies that are thinking, oh, I wonder if this AI thing that I'm working on is interesting, that is likely to be where they're going to end up hosting a lot of that. And we talked about how well Microsoft is positioned with their relationship with OpenAI. I think the companies you have to worry about longer term, obviously Tesla, they're in a tough spot. I think Elon Musk is absolutely brilliant, but you've got higher financing costs for cars, EV markets slowing down, and you got big competition from China, and our own government's not making it easy for them. You look at Google and you have to ask yourself, all these other companies are spending an enormous amount of money on AI. Do you think Google can maintain 93% search market share? I think that's going to be really tough to pull off. And then finally, you get to Apple, and Apple, you just look at the top line numbers, the revenues over the last 5 years, 3 years, 1 year has underperformed all the mega cap tech companies. For the most part, Tesla obviously this year's worse. But with the multiple it has in the mid-20s, if you do not get an iPhone upgrade cycle, and don't forget, they've got competition issues too, where China now can produce smartphones without US semiconductor chips, and they're pricing those phones very aggressively. Those phones already have AI features. You've already got foldable phones as well, which Apple does not have, which is a interesting category that people seem to want to have. That makes it tough for Apple going forward, I think. And they don't have a lot of their own AI technology. That's why they're talking about partnering with Google or OpenAI for their new iPhones. So that's how I think of all seven of them in terms of what I like and don't like on a longer term basis.
Well done touching them all. I want to zero in there quickly on Apple on that June 10th date for the Worldwide Developers Conference. There hasn't been much reason in recent years to go upgrade and get that new iPhone. How much pressure is on Tim Cook to deliver that, specifically as related to AI? And do you think it just comes in the form of a Siri upgrade or something much bigger?
Yeah, I mean, I always look at it and say, well, how much are people investing in their technology? So if you look at Apple over the last 12 months, they've had about 3% CapEx spend relative to their revenues, and on R&D, it's 8%. Now you compare that to a Meta, which is on the other end of the spectrum. It's 19% of revenues is spent on CapEx and 26% is spent on R&D. And Microsoft's at 19 and 26, at 17 and 12 for perspective there. So they don't spend a lot on technology, and that really shows up in their gross margins, which are in the 40s. And so I think there's a lot of pressure on Tim Cook in terms of, okay, we look like we've fallen behind a little bit here in terms of features on the smartphones because all the Android phones have got Google AI technology on the high-end flagship phones. So their multiple has gone up. That's the only reason the stock looks good. It's not because of revenues, because if you look at revenues, they're down 4% this March quarter versus a year ago. They're up 1% versus 3 years ago. And if you look at it even relative to 5 years ago, it's up 56%. The next worst out of the Mag 7 is Microsoft, up 102. So they've lagged over whatever time period you want to pick in terms of revenue growth. So the pressure, I think, is really high because I think the multiple we've seen this year, the stock's dead flat, people now are starting to, I think, wake up to the fact that this is not growing well and there is enhanced competition from China. And so I think the pressure's very high, but you're really not going to see that, I think, until you get to the fourth quarter and we figure out are consumers willing to upgrade their phones. And that's something we're not going to know for a while. But for right now, optimism, as it always does in front of Apple, is running high, and then the rubber will hit the road later this year.
Dana, how does the path forward for interest rates factor into your thesis on these different stocks?
Well, I think for all of them, it matters in varying degrees. For Tesla, obviously, it matters the most because, your car is a huge purchase and most people go ahead and finance that. And that's why you're seeing Tesla offering, low financing deals now to try to encourage people to buy cars. Tesla's revenues are down year over year for the first time since the height of the pandemic. I think it was June of 2020. And so that tells you how much pressure they're under. For the rest of them, it doesn't matter nearly as much. They're all cash rich. They're all throw off tons of cash flow. And so it's more, how does it impact the consumer in terms of the products that these companies sell? Obviously, for Apple, that matters a lot more than for Google, where, it doesn't cost you anything to enter in a search query, right? It'll affect the advertisers that advertise on Google, but in terms of impact, it's Tesla, obviously, biggest impact, and then I think you put Apple number 2 because of their high consumer exposure. Amazon's kind of in between because they tend to pick up share during recessions, so if things get tougher for the consumer, they go price shopping more. That should actually benefit to some degree their e-commerce business as people look for more bargains. And so that's how I would kind of put the mix between all of them.
All right, Dan Niles, founder and portfolio manager at Niles Investment Management. We appreciate it.